global warming is predicted to reach 3.2 degrees Celsius by the end of the century if we keep to the current state and don't strengthen climate policies. Rapid acceleration of emissions reduction efforts across the global economy is required if we are to meet Paris Agreement goals and limit global warming to 1.5 or 2 degrees Celsius, also meaning it's now or never. I am Holly, ESG specialist at Mirae Asset. In this video, I will share insights on transition climate change, what it means for investments, and how we consider climate-related risks and opportunities in our investments. Over the last decade, average annual greenhouse gas emissions were the highest in history. Because of the COVID-19 global pandemic, we saw a 4% dip in 2020, albeit a short-lived one as global emissions swiftly shot back up as economies started to open up. Against this backdrop, the world still needs to peak emissions by 2030 to keep global warming below 2 degrees Celsius. As the world transitions to a lower carbon economy, policy, legal, technology, and market changes have and will occur to meet the required mitigation and adaptation requirements related to climate change. For example, 33 countries and the European Union have set net zero targets, and more than 100 countries have proposed or are considering setting one. There is now a total of 48 emissions trading schemes around the world, 25 in force, 9 under development, and 14 under consideration. The number of newly filed lawsuits centered around climate and ESG issues has more than doubled since 2015, bringing the total to over 2,000 cases. Renewables are and will likely continue to be more cost-effective. 2/3 of renewable power added in 2021 costed less than the cheapest coal-fired options. Earlier this year, the IPCC published the third part of the 6th assessment report on the mitigation of climate change. The report summarized global developments in emissions reduction and mitigation and assessed the impact of national climate pledges in relation to long-term emissions goals. The report highlighted that an increasing share of global emissions will come from Asia, primarily due to its significant production-based emissions as a global manufacturing hub, as well as rising income levels and rapid growth in cities that will significantly increase consumption-based emissions. Nonetheless, we think there is a window of opportunity for Asia to drive and contribute to global climate action. Asia Pacific is well positioned for renewable energy development and investment, with capacity expected to increase by about 2 tetrawatts by 2030. Corporate climate action is strong and growing. More than 600 companies within the Asia-Pacific region have signed up to the Science Based Targets initiative. Asian countries are no laggards in rolling out mandatory climate risk disclosure requirements. Hong Kong, Japan, New Zealand, and Singapore are just a few early movers, with China, Indonesia, Malaysia, and others closely following suit. Globally, demand for low-carbon products and services could generate more than $12 trillion of annual sales by 2030 from offerings like green building, electric vehicles, carbon management, etc. A reallocation of labor could give rise to 200 million job gains and 185 million jobs lost by 2050. Let's hear what our analysts think.
Carbon price from government to tax externalities of carbon-intense sectors can impose financial implications on companies. China's national carbon emission scheme went live in July 2021, initially only covering power generation, but it is expected to cement and aluminum this year. Compared to the global counterparts like the Europe and California, the carbon price in China is relatively low. Nonetheless, materials companies are more incentivized. For example, cement companies, they may lower carbon emissions through the adoption of carbon capture and storage, use of alternative fuels, and so on.
For the transportation sectors, it is the second largest emissions contributors globally, closely followed by the power sector. And that's why we see a very strong desire by the global countries to make the transportation fuel usage much cleaner and more environmentally friendly. And that's why we have seen a lot of targets from different key countries such as US, Europe, and China to pave the way to electrify the whole automotive fleets and to make electric vehicles more available in the countries.
We integrate climate considerations as part of fundamental research to review each company's exposure and resilience to transition climate change. For example, for companies in sectors where climate change is a material topic, our proprietary ESG scorecard includes parameters such as whether the company has set carbon reduction targets and whether those targets are net zero aligned, as well as the company's estimated value at risk due to transition climate change. At the portfolio level, our SFDR Article 8 funds have exclusions on fossil fuels, such as thermal coal mining and power generation, as well as unconventional oil and gas, to lower exposure to risks that may arise from stranded assets. We are also delighted to announce that Mirae Asset has signed up as a signatory to the Net Zero Asset Managers Initiative. We look forward to sharing more on our net zero targets over the next year. Thank you for taking the time to watch this video. For more information, please refer to our Responsible Investments Report, which also includes our TCFD report on how we integrate climate change into our investment processes. We look forward to sharing more insights on ESG and climate change in future videos. Thanks for watching.